The greatest danger in the financial markets occurs not during panic selling but at the peak of euphoric buying. Investors often feel safest when prices are reaching new record highs. They see massive momentum and assume the trend is unstoppable. This belief is the precise psychological trap set by professional market operators. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. Wyckoff's methodology teaches that all major market movements are orchestrated. They are the result of deliberate planning and execution by the professional interest, which Wyckoff called the Composite Man. This entity controls the supply and demand necessary to move the market directionally. The silent shift from an uptrend to a collapse is known as distribution. Distribution is the methodical process of selling large amounts of stock. The professional operator must transfer their inventory to the public without crashing the price prematurely. This requires time, patience, and high levels of deception. The process occurs after a long, sustained advance. The Composite Man begins selling into the strength generated by public demand. They use positive news and the general excitement surrounding the asset to find willing buyers. The market appears incredibly strong during this phase. It is moving sideways, but the underlying intention has completely changed. Wyckoff observed that distribution is not a sudden event. It is a structure built in distinct phases. This structure is designed to absorb the enormous supply being released by professional hands. The market must hold stable while this selling is executed. During this period, the public sees consolidation. They interpret the lack of continued upward movement as a necessary pause before the next leg higher. They become the primary buyers, absorbing the supply being strategically released. This transfer of shares from strong professional hands to weak retail hands is the definition of the trap. Once the professional selling is largely complete, the market loses its primary source of support. The buying power has been exhausted by the Composite Man's supply. The structure is now saturated with inventory held by buyers who entered late in the cycle. This shift in ownership creates extreme vulnerability. Any negative news or minor selling pressure can trigger a chain reaction. The market then enters the markdown phase. This is the violent collapse that follows the quiet, deceptive lateral movement of distribution. Recognizing this critical shift requires understanding the specific technical signals. These signals are always present on the price and volume chart. They reveal the hidden actions of the professional operators. The key is to stop focusing on the headlines and start reading the language of the tape. The most fundamental error in technical analysis is confusing the two primary campaigns orchestrated by professional money. These campaigns are distribution and accumulation. Wyckoff taught that all major market movements begin with one of these two processes. Accumulation is the methodical process of buying shares. It occurs after a significant price decline. The goal is to absorb available supply from the public, the weak hands. This phase requires patience. It is often characterized by diminishing selling pressure. Distribution is the inverse operation. It is the methodical sale of previously acquired inventory. Distribution always follows a significant price advance. The goal is to sell shares into a wave of public enthusiasm and optimism. The location of the campaign is the first major clue. Accumulation takes place in the lower portion of the market cycle. Distribution takes place in the upper portion, near historic highs. The emotional environment is also critical. Distribution thrives on public greed. The news is overwhelmingly positive. Analysts are issuing high-price targets. The professional operator leverages this optimism to unload their holdings at the highest possible price. Accumulation, by contrast, thrives on public despair. News is negative. The professional operator leverages this fear to acquire shares cheaply. The relationship between supply and demand is the technical difference. In accumulation, demand is secretly overcoming supply. The professional operator is systematically placing bids to absorb selling. Volume often expands on down moves, indicating that large buyers are active. In distribution, supply is secretly overcoming demand. The professional operator is systematically offering stock for sale. Volume tends to expand on the rallies, indicating that supply is entering the market every time the price attempts to rise. Both distribution and accumulation are complex processes. They cannot happen instantly. The professional operator needs time to execute their large orders without collapsing the price or driving it up too quickly. Therefore, both processes occur within a defined trading range. This range is established to camouflage the activity. If the professional operator tried to sell their entire inventory all at once, the price would crash immediately. They would achieve a poor average selling price. Instead, they must distribute their inventory slowly. They use the public's buying power to provide the necessary liquidity. This necessary period of stealth trading is what Wyckoff called the distribution schematic. The distribution schematic begins with the first phase, known as Phase A. This initial phase reveals the first significant cracks in the underlying demand structure. The first visible sign of professional selling is called preliminary supply. This is where large institutions begin to unload inventory into the existing upward trend. They are testing the market's appetite for higher prices. Volume increases dramatically during this period. However, the market still manages to absorb this selling pressure, and the price continues its upward trajectory. Preliminary supply serves as the first subtle warning. It signals that the character of the market is changing fundamentally. Following the preliminary supply, the market usually reaches a point of absolute exhaustion. Wyckoff termed this critical event the buying climax. The buying climax is characterized by a final, rapid price surge. This is a dramatic run higher that captures the attention of the general public. Volume becomes exceptionally high, often the highest recorded volume in the entire campaign. This massive volume indicates a transfer of ownership from strong hands to weak hands. Public excitement reaches its absolute peak during the buying climax. Buyers are gripped by the fear of missing out on the final move. The professional operator uses this intense demand to execute the largest portion of their distribution strategy. They are selling directly into the frenzy created by emotional late-stage buyers. The high point established during the buying climax is rarely sustainable. Demand is finally overwhelmed by the sheer scale of the institutional selling pressure. Once the professionals have successfully offloaded significant inventory, the remaining genuine buying power vanishes almost instantly. This leads to an immediate and sharp decline in price. This sudden reversal establishes the upper boundary of the entire trading range. It defines the ceiling of the distribution schematic. The immediate fall from the buying climax is crucial for the analyst. It confirms that the professional interest has shifted entirely. The market is no longer in a phase of accumulation or sustained markup. It is now entering a prolonged period of selling inventory. This initial selling pressure marks the end of the prior trend and initiates the necessary consolidation period required for the full distribution to occur. The professionals have successfully trapped the late buyers at the highest price point. The immediate consequence of the buying climax is a sharp and sudden reversal in price. This powerful down move occurs because the supply that created the climax now completely overwhelms the remaining demand. The price cannot sustain those extreme highs. This rapid decline establishes the first major lower boundary of the distribution structure. Wyckoff called this necessary drop the automatic reaction. The low point of the automatic reaction defines the floor of the expected trading range. It marks the extent of the initial panic selling from those who bought late into the final rush. Following this drop, the market attempts a rally. This rally is essential for the distribution schematic to continue. It serves to test the supply-demand balance near the top of the newly formed range. This test confirms that the market is truly weak and that demand has disappeared. This second high point is known as the secondary test. The secondary test must ideally occur on significantly lower volume than the buying climax itself. Lower volume during this test confirms that the institutional interest in buying the asset is rapidly diminishing. If the secondary test successfully holds below the buying climax level, the boundaries of the distribution trading range are now firmly established. The range is defined by the high of the buying climax and the low of the automatic reaction. With these initial actions complete, the market formally enters Phase B of the distribution process. Phase B is the most time-consuming segment of the entire structure. This phase is characterized by sustained, choppy, sideways movement. The composite operator must continue to sell the massive remaining inventory without causing the price to break down prematurely. They cannot sell everything at once, or the market would immediately crash. Instead, the composite operator must methodically meet incoming demand with overwhelming supply, all while keeping the price contained within the boundaries. This range-bound action creates a psychological trap for retail traders. The market looks resilient, bouncing off the automatic reaction low repeatedly. The appearance of stability encourages short-term traders to buy the dips, believing the consolidation is merely preparation for a new upward movement. Each time a new buyer steps in, the professional seller is waiting. The composite operator uses the perceived safety of the trading range to liquidate their holdings slowly and strategically. This is the hidden selling zone. The longer the market stays in Phase B, the more stock is transferred from strong hands to weak hands, setting the stage for the eventual collapse. The distribution process primarily unfolds within Phase B. This phase is characterized by prolonged market indecision. The price moves laterally, churning between the support defined by the automatic reaction and the resistance established by the buying climax. This is the testing period. The sophisticated operator is actively selling into strength throughout this entire phase. This selling creates a critical footprint that the analyst must observe closely. The first hidden sign of active distribution is the persistent appearance of high volume on rallies and low volume on reactions. When the price attempts to rally toward the established resistance, volume spikes dramatically. This volume does not represent new institutional demand entering the market. Instead, it signifies heavy supply meeting demand. The high volume shows that professional selling is absorbing the retail optimism. The market attempts to advance, but the composite operator is capping the movement, ensuring price does not break out easily. This supply absorption is the core action of Phase B. Conversely, when the price reacts downward toward the range lows, volume often diminishes. This lack of significant selling volume on reactions is highly deceptive. If the professional operator were truly committed to marking the price down immediately, selling volume would increase dramatically on reactions. But that is not the goal in Phase B. The goal is liquidation. The market is not yet ready for the markdown. It must first exhaust all remaining buying interest before the collapse can begin. Low volume on the reactions confirms that the professional interest is centered solely on the selling side, not the aggressive shorting side yet. Phase B includes multiple secondary tests. These tests probe both the high and low boundaries of the range. The analyst must scrutinize the volume signature of each test. If a rally, which constitutes a secondary test near resistance, fails to advance on high volume, it confirms that supply remains dominant. The price action shows effort without results. The composite operator is deliberately creating a sense of safety and stability within the trading range. The repeated failure to break resistance, combined with recurring high volume at those levels, is the signal of massive stock transfer. High volume on the upside, followed by low volume on the downside, is the signature of supply absorption within a distribution range. This pattern confirms that the trading range is functioning exactly as a zone of distribution. The heavy activity is successfully transferring shares from strong hands to weak hands. This transfer prepares the ground for the subsequent phases of the markdown. The professional sellers are laying the trap perfectly. The next critical step involves luring in the final remaining buyers before the inevitable drop. This critical event is known as the upthrust after distribution. It represents the final, definitive manipulation before the market enters the powerful markdown phase. The trading range established during Phase B defines the selling zone. Professional operators must clear this zone to ensure maximum selling efficiency. They need to exhaust the last pockets of demand. The upthrust after distribution occurs when the price momentarily pushes above the resistance line of the established trading range. This action signals a powerful breakout and a continuation of the previous uptrend. Crucially, this signal is entirely false. The false breakout attracts two primary groups of market participants. First, the trend followers who believe the consolidation is over and jump into new long positions. Second, the short sellers who placed stop-loss orders just above the resistance. This mandatory covering by short sellers creates a sudden, powerful surge of buying pressure. The professional sellers use this induced demand as the perfect opportunity. They execute their largest remaining sell orders directly into this manufactured liquidity surge. The market is flooded with shares at the highest possible price. Volume during the initial push above the resistance is frequently high. However, the move lacks follow-through, and momentum quickly fails. The high volume represents exhaustion selling by the professionals, not genuine conviction buying. The market quickly stalls. It fails to hold the new highs for any significant period. Price then swiftly reverses direction and collapses back inside the distribution range. This reversal is the key confirmation of the trap. The true danger of the trap is sprung when the price violates the established resistance level, only to reverse and close significantly lower. The buyers who entered during this breakout are now trapped in losing positions. Wyckoff observed that this move serves to thoroughly test the remaining supply above the trading range. If the test reveals that demand is weak and professional selling is overwhelming, the market structure is complete. A successful upthrust after distribution leaves a distinct footprint. It creates a substantial pocket of weak holders at the absolute peak of the market structure. This setup is essential because it ensures that the subsequent decline will be rapid and forceful. These newly trapped buyers become future sellers when panic sets in. Their liquidation will fuel the coming markdown. The inability of the price to sustain the new high confirms a profound structural weakness. Demand is now utterly exhausted, and supply has become completely dominant in the market. The final preparation for the decline is complete. The false breakout is not just a failed rally. It is a calculated maneuver by the professional operator. This action, often named the upthrust after distribution, serves a crucial psychological function. It ensures that the maximum number of inexperienced traders are trapped on the wrong side of the market. Public traders often view the breach of the previous high as definitive confirmation. They interpret the move above the selling zone resistance line as the start of a new, powerful advance. They jump in aggressively, committing capital based on excitement rather than structural analysis. This surge of late, emotional demand provides perfect liquidity. It allows the major interests to sell their final large blocks of stock at the highest possible prices. The professional operator requires this buying pressure to complete their distribution process quietly. The upthrust after distribution is essentially a liquidity sweep. It draws in the last remaining optimistic buyers. The move above the resistance line also cleanses the market of protective orders. It forces the covering of short positions that were placed just inside or slightly above the trading range. These short sellers are stopped out by the momentary price surge. They are forced to buy back their shares immediately. This mechanical short covering provides another temporary boost of demand. This is necessary to facilitate the final selling campaign by the composite operator. Once these stops are cleared, and the new buyers are fully committed, the path downward is less obstructed. The professional operator wants to see a complete lack of follow-through buying after the initial thrust. They must test the market thoroughly to ensure that the supply line is truly impenetrable. Wyckoff observed that when the price fails instantly and collapses back into the prior range, the distribution is confirmed. This action proves that the market is inherently weak, regardless of the temporary hype surrounding the false high. The inability of the price to sustain the new high confirms exhaustion. It shows that the major interests have completed their selling campaign. Once the public money is trapped and the protective stops are triggered, the professional operator steps back completely. The buying pressure vanishes instantly. The price then falls rapidly back beneath the selling zone resistance line. This swift reversal is the final, definitive signal of the trap springing. The market structure shifts entirely from controlled distribution to uncontrolled markdown. Professional traders interpret this failure to hold the high as a mandate for short selling. The psychological setup is complete, and Phase D, the clear sign of weakness, is now imminent. The failure of the high signals a profound shift in market control. The selling pressure that follows must now break critical support levels. This break is known in the Wyckoff methodology as the sign of weakness. The sign of weakness is the definitive declaration that the distribution process is complete. It manifests as a decisive move below the prior support. This support was established either by the law of the automatic reaction or the law of the secondary test. This move penetrates the lower boundary of the entire established trading range. Volume must confirm this decisive action. Professional selling typically accelerates into the break, leading to significantly high volume readings. This heavy volume indicates that the supply the large operators absorbed during Phase B is now being aggressively unleashed onto the market. The professionals are confirming their bearish outlook and abandoning their positions. The appearance of the sign of weakness confirms the transition into Phase D. This phase is characterized by the clear dominance of supply over demand. Rallies become weaker and drops become sharper. The price structure no longer attempts to hold the upper boundaries of the distribution range. The market has committed to the downside. Following the initial break of the sign of weakness, the price often attempts a counter-rally back toward the broken support line. This pullback is critical for the professional short seller. Wyckoff termed this test of the broken support the last point of supply. The last point of supply provides one of the lowest risk entries for initiating short positions. It is essential that this counter-rally demonstrates profound weakness. It often features low volume, signaling a complete lack of genuine institutional demand to push prices higher. The rally struggles to move back into the previous trading range. The previously reliable support now acts as strong overhead resistance. This is a fundamental principle of market structure change. If the market fails to rally back into the range and instead holds below the broken support, the setup is complete. The professional money has finished its setup. The market structure is now unequivocally bearish. This confirmation mandates the final markdown phase. The descent into Phase E is the expected outcome after a confirmed sign of weakness and a successful test at the last point of supply. This markdown is typically swift and punishing. It is characterized by widening price spreads on the downside and escalating panic selling from uninformed traders. The distribution schematic has reached its fulfillment. The long-term trend has officially reversed. The initial major markdown confirms the decisive shift in control. Supply has completely overwhelmed demand. The professional operator now watches for the market's reaction to this decline. Any attempted recovery will expose the underlying structural weakness. This leads directly to the third critical warning sign. This sign is known as the shortened thrust. A shortened thrust occurs when attempted rallies become noticeably weaker. They fail to achieve the momentum or range expansion seen earlier in the distribution structure. During accumulation, thrusts are long and powerful. They show significant commitment from institutional buyers. During distribution, the exact opposite scenario unfolds. The effort exerted by the remaining buyers yields very little upward result. This is the manifestation of failed rallies. As the price attempts to move higher, it quickly encounters heavy overhead supply. This supply acts like a dense, impenetrable ceiling. It absorbs the remaining demand instantly. The inability of the market to sustain upward movement is a clear indication that new institutional money is not entering the market. The most common area for observing these failed rallies is near the last point of supply. This specific point is the final opportunity for the composite operator to sell short. They liquidate their last remaining shares into the hands of uninformed traders attempting to buy the dip. Observe the volume characteristics during these small upward moves. The rally often occurs on diminished volume. This lack of participation confirms a lack of institutional sponsorship. When the price fails to hold and begins to roll over, the volume spikes immediately. This sudden surge confirms the sheer dominance of selling pressure returning to the market. The short sellers are now in full command. This repeated pattern of failing to hold a rally traps uninformed participants. They interpret the small bounce as a chance to buy the perceived low price. They believe the previous high was simply an anomaly. The failure of the rally crushes that hope and forces capitulation. The consistent appearance of shortened thrusts and failed rallies is definitive proof. It shows that demand has been completely exhausted within the trading range. The professional traders have finished their distribution campaign. The market is now ready to transition fully into the final phase. The major markdown is imminent and unavoidable. The distribution schematic is the master blueprint. It illustrates the entire process of professional selling. It moves through distinct, recognizable phases that every analyst must understand. The structure begins with Phase A, the stopping action. This phase ends the prior upward trend. The preliminary supply first warns of impending weakness in the market. This is followed quickly by the powerful buying climax. The buying climax halts the upward move completely. The immediate reaction downward defines the range. This is the automatic reaction. The subsequent secondary test confirms the strength of the resistance level. It also establishes the initial support of the trading range. Phase B is the longest and most crucial period. It is where the cause is built for the eventual effect. The composite operator systematically sells their holdings throughout this phase. They are distributing large blocks of stock to the remaining demand. This selling occurs without allowing the price to break the established support. Price swings widely within the defined boundaries. Multiple secondary tests often occur during Phase B. Volume tends to remain high, indicating heavy professional absorption of remaining demand. Phase C is the decisive test of the structure. It is designed specifically to trap late buyers who are anticipating new highs. This phase almost always contains the upthrust after distribution. This is a false breakout above the resistance line. It convinces retail traders that the upward trend is resuming and the distribution has failed. However, the move quickly fails. It is the final opportunity for the composite operator to sell any remaining shares at high prices. When the price fails to hold the breakout, the distribution structure is nearly complete. Phase D provides the clear, actionable warning. It confirms that supply is now dominant over demand. The price breaks the established support level of the trading range. This critical break is called the sign of weakness. It indicates that the balance has shifted irrevocably. Any rally attempt following this break is weak and short-lived. This failed rally forms the last point of supply. This specific point confirms the integrity of the distribution structure. Demand has completely failed to push the price back into the safety of the trading range. The completion of Phase D sets the stage for the final act. The market now stands ready for Phase E. This is the steep and rapid markdown. Understanding this step-by-step progression is paramount. It allows the analyst to anticipate the market's next major and profitable move. The anticipation of Phase E naturally leads to tactical trade execution. The professional trader seeks low-risk entry points. These points are generated by the specific events of Phase D. The primary goal is to enter the short position just before the final markdown begins. This placement maximizes the reward relative to the defined risk. There are two optimal tactical short entry opportunities derived from the distribution schematic. The first is an aggressive entry. This occurs immediately following the failure of an upthrust after distribution. When the market breaks back down into the trading range, the short position is initiated. The stop loss is placed just above the peak of that upthrust after distribution. This entry offers substantial reward potential. It also carries the risk of a potential whipsaw action. The more conservative and preferred entry point occurs later in Phase D. This entry is triggered after the market produces a clear sign of weakness. The sign of weakness breaks below the established support of the range. After this break, the market often returns to test the underside of the broken support. This test of the broken support is critically important. It confirms the resistance is holding. This event is known as the last point of supply. The short sale execution occurs as the price rejects this overhead resistance. Ideally, the volume accompanying this test should be relatively low. Low volume confirms that institutional buying support has completely vanished. Setting the risk parameter is mandatory before any trade is executed. The stop loss must be defined precisely by the structure itself. For the last point of supply entry, the stop loss is placed immediately above the high of that specific test rally. If the market trades above the high of the last point of supply, the distribution structure is immediately invalidated. The short position must be closed quickly. The structural integrity of the schematic is the ultimate arbiter of risk management. Trading outside the defined boundaries signals that the professional money is not yet ready for the markdown. The maximum risk is defined by the distance between the entry price and the stop loss. The potential reward is measured by projecting the size of the markdown. Wyckoff emphasized quantifying the expected move using point and figure charting. This quantitative methodology provides a horizontal count. The count projects the minimum expected vertical decline for Phase E. The professional trader ensures that the potential reward significantly outweighs the defined risk. A ratio of 3 to 1 or better is generally sought before committing capital to the trade. The successful execution of a short trade relies entirely on adherence to foundational principles. Ignoring these principles transforms a calculated maneuver into a high-risk gamble. Wyckoff established 3 universal laws that govern all market action. These laws explain why distribution occurs and why prices must fall afterward. For the professional trader, these laws are not theoretical concepts. They are necessary filters for trade confirmation. The first fundamental law is the relationship between supply and demand. This law is simple yet absolute. When supply exceeds demand, prices decline. During the distribution schematic, the repeated appearance of selling pressure confirms that supply is overwhelming the remaining demand. Traders who attempt to buy during Phase C or Phase D are actively trading against this dominant force. They are ignoring the clear evidence that the composite operator is systematically injecting supply into the market. This consistent supply injection validates the short bias. The second law is cause and effect. Every period of horizontal price consolidation, whether accumulation or distribution, serves as the cause. This cause builds energy within the trading range. The subsequent trend, the markdown or the markup, is the inevitable effect. The professional trader uses the horizontal count to quantify the cause. This measurement provides a minimum expected vertical movement for the effect. If the distribution range is long and wide, the resulting markdown will likely be severe. Ignoring the scope of the cause leads to underestimating the potential for the effect, resulting in premature profit-taking. The third and perhaps most crucial law for identifying market deception is effort versus result. Effort is measured by trading volume. Result is measured by the subsequent price movement, or thrust. During the final stages of distribution, high volume often appears. This represents massive effort. However, this effort often produces a negligible result. For example, a high-volume rally may fail to sustain movement beyond the midpoint of the distribution range. This divergence signals a critical failure. Institutional selling is absorbing every ounce of buying effort. The market is expending significant energy without achieving any meaningful upward progress. When great volume appears but the price thrust shortens or reverses quickly, the market is sending a clear message. The supply is simply too heavy. Recognizing this effort versus result failure protects the trader from falling for the final buying traps before the inevitable markdown begins. The failure of effort versus result signals that the professional money has completed its objective. The distribution process is finished. The market is now poised for the inevitable markdown. This final stage of the schematic is known as Phase 5. Phase 5 represents the decisive break from the established trading range. It is the period where supply completely overwhelms demand. This is the payoff phase for those professional traders who correctly identified the distribution pattern and positioned themselves short. The market will see a clear, decisive break below the critical support level. Wyckoff referred to this support line as the creek. This penetration of the creek is typically accompanied by a significant increase in selling volume. This volume confirms the institutional commitment to driving prices lower. The velocity of the markdown in Phase 5 is often rapid and steep. There is less congestion. There are fewer secondary tests compared to the drawn-out action seen in the middle phases of the trading range. The goal of the professional operator shifts entirely. It moves from selling inventory to realizing profits from short positions taken at much higher prices. For the active trader, the initial break of the trading range often provides a final high-probability entry point. If the initial short entry was missed, perhaps after the upthrust after distribution or the sign of weakness, the trader often waits for the first substantial pullback. This pullback occurs after the initial break of the trading range. The broken support line now acts as powerful resistance. This pullback offers a defined risk opportunity. Risk is strictly managed by placing the stop order above the newly confirmed resistance level. Capital preservation during this volatile phase is always paramount. Understanding these technical phases is not just an exercise in chart reading. It is about establishing a disciplined business approach to market operations. Richard Wyckoff detailed this approach in his essential work, How I Trade and Invest in Stocks and Bonds. This text is not a general guide to wealth management. It is a manifesto on the business of trading. He emphasized that trading must be treated as a serious business venture, not a form of gambling. The successful operator must always treat capital preservation as the primary duty. Wyckoff strongly warned against the fatal mistake of averaging down into losing positions. Every trade must be protected by strictly limiting risk. The professional trader learns to judge the market solely by its own action, price, and volume, and ignores the outside noise. That discipline is the foundation of the Wyckoff method and the key to navigating the distribution trap successfully. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent, but knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.